Hi there. Thanks for tuning in. Today we're going to be doing an analysis and valuation of Turtle Beach Corporation. So let's get started. First of all, who are they? They're a gaming accessories brand, basically. Mostly headsets. That's what they started as. They're the best-selling gaming headset brand for the past 14 years. And they have a bunch of other gaming accessories. They have headsets, peripherals, controllers, flight sticks if you use those. So that's what they do, and they have over 400 patents to back that up. So if you want peripherals, chances are you will probably find Turtle Beach in your search at some point. And they have acquired other companies to make sure that they have an even larger peripheral portfolio and acquire their IP while they're at it. So yeah, this is what they do. Now, I want to first do a little bit of my own research with the projected growth of the gaming industry. Really, the number I'm looking at is this 7.39 or 7.93%. So that's what they're saying. The gaming industry is going to grow from 2024 to 2029 for the next couple of years. It's that per year. Would I expect accessories to grow by that much? Not really. I mean, you have to think that at the end of the day, even though the gaming industry grows, the accessories, you can say not everyone is going to purchase an accessory. So let's just say if the gaming industry grows close to 8%, accessories may grow close to 4% or something like that, 5% maybe. So that's, I think, something realistic there to note that you can't just equate it to gaming, but you want the overall sector that it sells to be growing and growing well, which gaming clearly is. Okay. Now, their growth strategy, they have all these different markets of headsets, of peripherals, microphones. They have the flight sticks, which is also a huge market, and the wheels. I know people who are really into those, and they are willing to drop a fortune for those. So if Turtle Beach can make good ones of those, they'll have a loyal fan base there. So yeah, they're designing high quality products. They want to keep being leaders there, and then like operationally executed even better every time. So they're the market leader here by far. They have a pretty good position here. Now, here's what I don't love about pie charts. They don't have the actual percentages here. So for all we know, this is made up. But I do believe that they're the number one gaming headset, especially for Xbox and PlayStation. For PC, probably not so much. And some of the top sellers here are just Turtle Beach in general. I have used Turtle Beach before. I think they're pretty decent. But at the same time, I went and did a quick search on Amazon for gaming headsets. And you see here, I see three brands. They're not Turtle Beach. If you scroll down a little bit, you do see Turtle Beach, but that's the point of trying to drive here is that they still have competition at the end of the day. At the end of the day, everyone can go and make a gaming headset. Will it be as good as Turtle Beach? Will it have certain proprietary technology? No, but at the same time, the barrier to entry is still pretty low, and they do have competition, especially at the lower price point, by all sorts of companies. Razer, Jabil, the what's it called? Logitech. Yeah, of course. So yes, they are a market leader, but there are a lot of competitors, so they have to stay on top of the game. And that's important for us to know as well. So they do, however, compete at every price end. So they have the entry level and the casual headsets, and yet they also have for high-end gamers even a headset that goes for $350, the Stealth Pro, for people who play 15 plus hours per week. So there you go. I mean, they do compete in different ways. It's similar to when I did the Movado analysis, which I will link on the side, where we're talking about how watches can be competed on at multiple price points. It's not the same someone who competes only with luxury watches than someone who competes with more accessible watches or someone who competes through multiple price points. Then you have different competitors in different sectors. So if one dominates a certain sector, like the high-end luxury, at least you have the other ones that you're competing in. Now, for the second quarter of 2024, they have revenue up, they have gross margins up, their full year EBITDA guidance was raised, they repurchased common shares, and the US video games accessories market is looking pretty good. So overall, they seem to be doing pretty good. However, that's just the latest quarter. I want to actually go to the long term here. So we have sales, we have net income, and we have free cash flow. So before, I mean, we see what young companies go through, which is generally that they have a lot of revenue and they don't have net income. Usually that is because of inventory issues, because they're still figuring out marketing. They're just in growing mode. Starting 2018, they start having positive numbers all across the board until about 2020, 2021, and now we're back here in this little bit complicated area, which is 2022 and 2023, where their net income just plummeted and the free cash flow did too. And even though 2023 had positive free cash flow, a lot of that is because of adjustments in different things rather than them actually making income, which is the first thing that comes into free cash flow, the first hopefully positive value in free cash flow. So you have to know that. You have to know that their free cash flow prospects aren't as great as they once were. If you did a valuation over here where the free cash flow margins were something like 15%, it would have looked amazing. And then this would have happened and this would have happened. And then your investment would have happened as great. So now we're looking at a Turtle Beach that's potentially in financial recovery and in a market that's now growing again. So that's important. So let's do a valuation. So first of all, my assumption here is that Turtle Beach is growing. They're going to grow significantly in 2023 and 2024. I'm saying about 8%. And then from there on, I'm growing them about 4%. And I'm going to say that 5% of their revenue is going to be turned to free cash flow, just a very simple number. Now, my required rate of return personally is 11%. That's 1% more per year than the market on average. The perpetual growth rate I'm assigning them is 3%. So from 2027 onwards, they're going to grow up by 3% every year. I feel like that's reasonable given that the gaming industry is growing pretty rapidly. I divide that by the total number of shares out, and I get a fair value of $12.10. However, if I subtract the net debt, which they recently issued some, and they issued some to do an acquisition and to do share buybacks, then I get an actual value of $8.87 with an 11% required rate of return and 3% perpetual growth rate. Now, right now they're sitting at around that $15 level. So very different. And they did have this downturn around 2022 when their profits started turning downwards in 2023. Recently, this spiked back up because they're beating expectations. However, if you'll compare it to here, you'll see that my valuation is a lot lower than their actual price. So what's up here? Well, there's risks and rewards. Turtle Beach may be a market leader, but the market itself is very competitive. That's why I stressed it so far. This doesn't mean they won't grow nicely. They will probably grow quite a bit, at least in revenue, of course. But it does mean that expectations shouldn't be aligned for a should be aligned for a more competitive industry. They're not going to be one of these companies that just captures this specific segment and they have no competitors because they're the first ones to market and then all of a sudden they're growing 25% per year. They're not doing that. They're a company that can grow easily 5% per year, very easy, but not 20%. So you have to reflect that accurately. Besides, the recent share repurchase plans come after having diluted shares for the last 2 years and after having issued a little bit of debt to buy back shares. That's sort of that financial engineering you see there. And then free cash flow numbers still have to regulate a little bit. So they diluted shares in order to buy a company, to make an acquisition. Now they're issuing debt to buy back those shares, but then they have to pay that debt anyways eventually. Now, lower interest rates may be convenient for them, but do you really want to hold on a company that's doing that? Eh. In other words, the growth is there, but the risk is also there. At the right price, it's very interesting, but for now, I'd personally just sit it out. So just remember, evaluate risk first. The point of me showing you for example, competition and a lot of these nuances to the things that they're doing is because you have to look at the risks first and then ask yourself if the reward is compatible with the amount of risk that you're taking on by opening a position in a certain company. Now, thank you so much for watching. Really, really appreciate it. If you want more content like this, don't forget to like, subscribe, and hit that notification button. It really, really helps me out, so I appreciate it a lot. Thank you so much for watching and have a great rest of your day.